Since I began working with clients over 20 years ago, there has been tremendous information on the benefits of delaying Social Security for many people. So much information has come out that Congress even made changes to some of the rules on how people can collect Social Security benefits. And for most people, it makes sense to wait until their full retirement, if not until age 70, to collect Social Security. And this is especially true for a couple where one spouse has a much higher Social Security benefit than the other.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
Welcome back. This is episode 108. In this week's episode, I'm going to address what I think are the top 5 retirement mistakes that people make and how you can avoid making these mistakes. And if you've been on my website, morrisseywealthmanagement.com, you're probably aware that I have a top 10 retirement guide, top 10 retirement mistakes to avoid. And I would also suggest going there and downloading that if you haven't. In that, you'll be able to cover the remaining 5 mistakes, but I'm going to focus on what I think are the top 5. And I've actually added one to that list that I didn't have on before. The number one mistake I see people making is paying too much in taxes. And people are doing this both on a pre-retirement basis and also post-retirement. Pre-retirement, I see people missing opportunities for deductions. And if your employer has a 401k or a 403b plan and they have an employer match, you definitely want to be taking advantage of that. Let's say you have to put in 5 or 6% to get the maximum company match. That would be the first thing that you'd want to do. Next, if you're like most people and you're on a high deductible health plan and you have access to a health savings account, that would probably be your next deduction that you'd want to take advantage of. And you have a maximum that you can contribute to that. I've talked about this in a number of episodes. I'll put a link in the show notes, or you can just search on Retire with Ryan HSA. But as an individual, you can put in $3,650 for 2022. And if you're over 55, there's an additional catch-up contribution of $1,000. The great thing about that account is that money all goes in pre-tax. You can invest the money. And I would recommend doing that if you're not planning to use the money in the near future, as you probably shouldn't. And then when you take the money out, if you use it for health-related costs, it's all tax-free to you. That's why it's such a great account. And if you have a dependent or you're married, you're considered a family. So your deduction now goes up to $7,300. And then if you're over 55, you can also put in that additional $1,000 catch-up. And if your spouse is also over 55, they can put in the $1,000 catch-up. So that's a big opportunity I see people missing out on. And let's just say you had more money that you wanted to put away from there and you wanted to do it on a pre-tax basis, then you could go back and continue contributing into your 403b or 457 or 401k plan, going up to the limit of $27,000 if you're over 50, and it's $20,500 if you're under 50. And if you are someone who's in a high tax bracket, usually it makes sense to be putting money in on a pre-tax basis because the belief is that when you retire, you will be in a lower tax bracket. If you think your tax brackets will be similar when you retire to when you're working, then you might want to be contributing to the Roth 401k or Roth IRA instead. And let's just say that now you're retired and, as you probably know, the Roth IRA and Roth 401k are newer saving options. And for the most part, many people that I sit down with that are in their late 50s, early 60s, the majority of their money is in a 401k or 403b or 457 plan that's on a pre-tax basis. And what that means is you took deductions when the money went in, but now when it comes out, you're going to have to pay tax on the money. And that could be problematic if now you're retired and you have Social Security income, especially a husband and a wife or a couple, and you also have pension income. It's very possible that your income could get up to a higher level where now once you start taking those IRA or 401k distributions, that's putting you into a similar tax bracket to where you were when you were working. And if you remember, once you reach age 72, any monies that you have in retirement plans, 401k, 403b, 457 plan, and also IRAs, there's a forced distribution at 72, a certain percentage that you have to take out. And what some people think is best is to leave that money alone and wait until 72 until they start touching it. And that is certainly one option. But an alternative could be, rather than waiting to that point, you start taking money out sooner, and that could potentially have you paying tax on that money in a lower tax bracket. So there's potential tax savings there, and that's where some of the tax planning comes into play. Let me just give you an example. Let's say we have a married couple filing jointly in 2022. They would pay 10% federal tax on their first $20,500 of taxable income, then 12% federal tax on the next $63,000 of taxable income. Once they go above that, now they're in the 22% bracket, 22% federal tax bracket. But before you calculate your taxable income, you're able to take any deductions that apply to you. Most married couples now in Connecticut are getting the standard deduction, which is $25,900. And then if they're over 65, they're eligible for a $1,300 additional per person deduction. So that would allow a married couple filing jointly to have taxable income up to $112,000 before entering the 22% federal tax bracket. So if you're in that situation where you could have taxable income up to $112,000 and you have IRA monies that you were planning to defer until 72, why not take that money out now and pay tax on it where you know you're paying a maximum rate of 12% rather than waiting for that money to grow further where it could now push you possibly into the 22% tax bracket. We're also assuming too that the tax brackets stay the same, and our current tax laws, if Congress doesn't do anything to them, which they could do, will sunset at the end of 2025. And now we'll go up into higher tax brackets that we're in prior to the current tax brackets. Another thing that you could do with this money, if you're taking it out and paying tax on it from your retirement accounts, is that if you're not going to use it, you could also move that over to the Roth IRA account. By doing that, that would allow you to take the money out, pay tax on it, but you've now shifted it over into the Roth IRA. And with the Roth IRA, there are no required minimum distributions, and when the money comes out, it's tax-free. So that could be a way to get some of this money that you have that's mostly on a pre-tax basis, pay tax at a maximum rate of 12%, and shift it over to something that would be tax-free for either you to use during your retirement, or if you don't use it and you have children or grandchildren, then they could receive it and they could get it tax-free also. So that's a definite opportunity there. Number two mistake that I see people make is collecting Social Security too soon. Since I began working with clients over 20 years ago, there has been tremendous information on the benefits of delaying Social Security for many people. So much information has come out that Congress even made changes to some of the rules on how people can collect Social Security benefits. And for most people, it makes sense to wait until their full retirement, if not until age 70, to collect Social Security. And this is especially true for a couple where one spouse has a much higher Social Security benefit than the other. And in this scenario, the higher earning spouse should delay their benefit as long as possible, preferably waiting until age 70 to begin collecting. And in many relationships, the spouse with the higher benefit is a male. Males have also a shorter life expectancy than females. So by the higher earning spouse delaying their benefits, this will allow them and their spouse, if they survive them, to receive the highest possible survivor benefit. Because with survivor benefits, the survivor receives the higher of the two benefits. However, what I found is despite knowing all the facts, many people struggle to wait to collect. They feel they've been paying into Social Security for many years, especially if you started working at 16, right? And now you find yourself being 62, or you're thinking, wow, I've been paying into Social Security for almost 50 years. How can I wait until full retirement or maybe even till 70? But if you have other retirement funds, you'd be much better off taking money from those accounts and delaying your Social Security benefit at least until full retirement, if not until age 70, or at least for the higher earning spouse. Additionally, as I'm recording this, we have very high inflation in the US. We have readings of 9 to 10% inflation, depending on what you're looking at. And Social Security has the cost of living adjustment every year. The cost of living adjustment for this year was over 6%, the highest in almost 40 years. So if we still have high inflation going forward, you will also see higher cost of living adjustments for Social Security. This is an even greater reason why you should be delaying your benefit, because if you have a higher monthly benefit that you're getting from Social Security, you'll get a higher cost of living adjustment on a dollar basis, more money in your pocket. Mistake number 3 I see people make is not having an investment policy statement. Every investor should have an investment policy statement. If you're not sure what that is, it's a guide that establishes the framework for your portfolio. It details what your target asset allocation is and which assets you will invest in, your investment time frame, your cash flow needs, and your system for maintaining your investments. Without one of these, you're essentially winging it, and you sometimes can become a collector of investments. You buy a mutual fund here, your friend tells you about a hot stock, you invest in your company's target date retirement fund, and you believe that you have a diversified portfolio, but you don't have any clear direction. And even worse, you're buying and selling based on your emotions, meaning when things are going down, you're selling, when things are going up, you're buying. And this is really not a way to have long-term success as an investor. You definitely want to take the first step of establishing your investment policy statement and making sure you use that to guide you. This is something we use for all clients, and it helps to bring clarity to their strategy, and it helps to let them know that there's a plan in place for their investments so that they can stick with their investments in the long run. Mistake number 4 I see people making is not knowing where they stand. Would you plan a trip somewhere without knowing your starting point? You wouldn't even be able to begin to know where you would fly, drive, or simply walk. Would the trip cost you $50, $5,000, $50,000? Would you be gone for one day or a week? Unfortunately, this is the way many of us approach our financial plans. In fact, in its recent 18th annual retirement survey, Transamerica's Center for Retirement Studies asked more than 6,300 U.S. workers to estimate the money they would need for retirement, and nearly half of the participants supplied a dollar amount by guessing alone. Only 7% opted to use a retirement calculator. And often people are unwilling to calculate their retirement needs, maybe out of fear that the necessary amount will be impossible. But without doing this, it's impossible to know where you stand when it comes to your retirement. So if you are not planning, or at least getting an idea of how much money you need to be saving, what your retirement income will look like, you're really doing yourself a disservice. And a lot of times through your employer, there's free tools within your 401k or retirement plan where you can do some rough calculations of where you stand. Working with a financial planner such as myself who specializes in retirement planning can be very helpful to get clarity about where you are, where you want to go, and what you need to do to get there. And that brings me to retirement mistake number 5 I see people making. And that is poor choices of either financial advisors or products. And there's a lot of people out there marketing themselves as financial advisors. I've talked about this in past episodes of especially when I focused on how not to get ripped off by your advisor. And unfortunately, our regulatory bodies are not really doing what they should be to not allow people who are really financial advisors, and in my view, that would be someone who's a fiduciary, who always puts your interest first, and not someone who's a broker, to identify themselves. It's really hard for you, the consumer, to understand the differences. And one question I would ask, or I would do some research on any potential advisor, is to know if they were a fiduciary and put that in writing. And unfortunately, even asking that is not enough. I've seen people calling themselves fiduciaries because they are registered as an investment advisor, but they also have a broker-dealer license or an insurance license. And that, in my view, is completely wrong, that they'd be calling themselves a fiduciary. They're really a part-time fiduciary. And you as a consumer don't know at any time which hat they're wearing. Are they wearing their broker hat, where they're going to get a commission by recommending a product to you? Or are they wearing their advisor hat, where they're trying to do what's in your best interest? The one thing you could do to avoid that is you could just only work with somebody who's a fee-only financial planner, fee-only investment advisor. You're going to know that they're only getting paid either on a flat fee or hourly rate, or if they're also managing your portfolio based on a percentage of the assets that they're managing, so that whatever the investment recommendation is that they're giving to you, you can have confidence in knowing that it's in your best interest. Another thing you can do is you can check out any potential advisor that you're considering working with by going to a website like Broker Check. If you type into Google Broker Check, FINRA's Broker Check, that's a way that you can research brokers. If you found someone on there and they're telling you they're a fiduciary, well, you're going to see very quickly if they're registered as a broker. If they are, they're not a fiduciary. If someone is a fiduciary and they are a fee-only advisor, you'd go to advisorinfo.sec.gov, and that's where you can look up people that are working on a fee-only basis. And if someone has an insurance license, that's kind of a gray area. If someone's just registered as an insurance agent, you have to check with each state to make sure that they're actually registered. And one thing I often tell clients is that if you want to make sure you don't get ripped off by your financial advisor, or you don't get made off, you want to make sure that you're never writing a check to your financial advisor, investment advisor, unless it's a fee you're paying. And any investment you're making should be written to a third party. So for my clients, we use TD Ameritrade and Charles Schwab to hold our clients' money, so that any investment a client's making, the check is being written to one of those companies. We don't hold any of our clients' money. That's how Bernie Madoff was able to commit the fraud that he did, because he held all of his clients' funds within his own company account, and he was able to then make up fake statements. If you're using a third party to hold your money, it's impossible. I mean, I guess Charles Schwab could get in on the fraud, but I don't think they would do something like that, considering they're managing billions or possibly trillions of dollars. One other thing, too, is that you can look for your financial advisor to have credentials. Probably the most important credential you could look for is the CFP designation. That stands for Certified Financial Planner. If someone has gone through that process and attained the ability to use the CFP designation, they've really put forth a large amount of effort, a year to 2 years of studying, depending on how much studying they did. And they also have a commitment at all times to an ethical commitment with the CFP designation to put your interest ahead of their own. So that's another layer or another level of credential you can look for to try to make sure you're getting the best person you can work with. So as I mentioned before, you can go to retirewithryan.com and you can sign up to download the rest of these top 10 retirement mistakes to make sure that you avoid them. I know there's probably a lot more than 10 mistakes that you can make, and you really only get one chance to do it right when it comes to your retirement. So make sure that you're doing a lot of research, or doing research in conjunction with getting the help of the right financial professional. As a reminder, my retirement planning classes are starting up again in the fall. If you want to take your retirement planning to the next level, consider attending my 2-night workshop where we cover a tremendous amount of information when it comes to your retirement planning, so that you could help put the right framework together. And you can sign up for those courses by also going to retirewithryan.com and then clicking on retirement workshops. Have a great week, and I look forward to talking with you next Wednesday. Take care.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.